Welcome to the TValue 6 video training series. We're going to talk about doing a TDR, Troubled Debt Restructuring, and we're going to do a simple interest rate reduction and show you the methodology to do the allowance for loan loss. What we're going to be doing is we're going to create two schedules. The first one is a TDR schedule, or the loan modification, and what we're going to do is we're going to replicate the terms of the loan modification. And the reason we're doing that is to find out what our expected future cash flows are. Once we have our expected future cash flows, we're going to discount it at the original or contractual interest rate, and we're going to call that our NPV, or net present value calculation. And once we have those two numbers, we'll be able to determine what our allowance for loan loss is. So let's look at some assumptions. Let's say we have a $200,000 loan modification. It was done at 3%, and we're going to do a 30-year term, so we're going to stretch it back out to its original term. But we know what the original interest rate was, 4%, which was the original contract. And what we're going to do now is figure what that allowance for loan loss is based upon the expected future cash flows. So let's jump into TValue. And here we have our ABC company dash TDR. So our naming convention is we want to call this the TDR, which is a loan modification. And you do want these numbers to agree to your agreement on the modification. So when the auditors come in, they can check, 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 and be done. We said our loan modification rate would be 3%. We have our loan for $200,000. We'll go ahead and put U for unknown on line 2. Figure out what our payments are over the next 360 months. And delete that guy. And calculate. And our payments are $843. So that is what our expected future cash flows are. So we have our TDR schedule. We'll go up here and we'll hit File and Save. And now we're going to create our net present value calculation. So we're going to go File, Save As, and this is the business process. We're going to change TDR to NPV, or net present value. And now we're going to change our labels, so our schedules agree, NPV. And now we're going to go back to the original interest rate, which was 4%. And now we're going to make the loan, we're going to put U for unknown. So now we're going to discount the expected future cash flows at the original interest rate, and the net present value of that is going to be $176,000. So the difference between the $176,000 and the $200,000 is our allowance for loan loss as of January 1st, 2018. If you were going to add other levels of the deal structure on the loan modification, let's say you did an interest only or you did a rate change, once you get to the net present value, you need to take the interest only payment and normalize it, so put a hard dollar in there, and then you also need to delete any rate changes. The reason is you only want your expected future cash flow. So you always do two steps, which is to change the interest rate to the contractual rate, putting U for unknown, and if you did interest only, you would normalize that, and if you did a rate change, you would eliminate that. You only have your future cash flows. So pretty straightforward steps to do. Once again, you always build your NP or TDR schedule for your loan modification. Make sure that agrees with your agreement, and that it determines what your expected future cash flows are, and then you can go ahead and discount that. We go to our summary here. You'll see that we have our $200,000. Our net present value was $176,000, which would leave us an allowance amount of $23,000. And that would be as of the date of the calculation, and then you would do your accretion calculation after that. And if you ever need any help or have any questions, feel free to reach out to us at info@TimeValue, or you can give us a call at 800-426-4741. Thanks for listening.